Have you ever wondered if the stock market is rigged? If so, you're not alone. Many ordinary investors suspect that something isn't quite right. The truth is, the stock market can be a complex and often unfair system, where powerful players employ manipulative tactics to tilt the scales in their favor. This essay delves into the dark truth about stock market manipulation. We'll expose the various strategies used to artificially inflate or deflate stock prices. We'll also examine the impact of these manipulations on both individual investors and the overall market. Are you ready to uncover the truth and arm yourself with the knowledge to protect your investments? Let's dive in. Stock market manipulation, simply put, is the artificial inflation or deflation of stock prices. This is done through various deceptive practices, all designed to mislead investors and generate profits for the manipulators. We'll explore the mechanics of these tactics, from the infamous pump and dump schemes to the more sophisticated techniques like spoofing and layering. Understanding these methods is crucial for any investor who wants to navigate the markets with their eyes wide open. By understanding how manipulation occurs, you can begin to identify the warning signs and protect yourself from falling prey to these schemes. Knowledge is power, especially in the world of finance. Before we delve into the specifics of market manipulation, it is important to acknowledge that the financial world thrives on information and the lack thereof. Access to timely and accurate information can mean the difference between a profitable trade and a devastating loss. However, not all market participants have equal access to information. Insiders, institutional investors, and high-frequency traders often possess a significant informational advantage over individual investors. This asymmetry of information is a breeding ground for manipulation. It's crucial to remember that the information you receive, whether from financial news, social media, or even your broker, may not always be complete or unbiased. Always approach financial information with a healthy dose of skepticism and conduct your own due diligence. Let's pull back the curtain and expose some common tactics used to manipulate stock prices. These tactics can be sophisticated and often go unnoticed by the average investor, but they can have significant impacts on the market and individual portfolios. Pump and dump. This scheme involves inflating a stock's price through false positive statements. Manipulators then sell their holdings at the inflated price, leaving unsuspecting investors with losses when the price crashes. This tactic preys on the fear of missing out, driving up demand and creating a bubble that bursts. Spoofing. This high-frequency trading strategy involves placing large orders that are never intended to be filled. These spoof orders create a false sense of market depth, tricking other traders into buying or selling at manipulated prices. Layering. Similar to spoofing, layering involves placing multiple large orders at different price levels. This creates the illusion of significant buying or selling pressure, influencing other market participants to follow suit. These are just a few examples of the many ways in which stock prices can be manipulated. Understanding these tactics is crucial for investors who want to protect themselves from potential losses. It's a constant game of cat and mouse, with regulators trying to stay one step ahead of the manipulators. Despite their best efforts, new tactics and schemes are constantly being developed, making it an ongoing challenge to maintain a fair and transparent market. Section 5. Winners and losers, who benefits and who suffers. The unfortunate reality is that stock market manipulation benefits a select few at the expense of the many. Hedge funds, institutional investors, and high-frequency trading firms are often the primary beneficiaries of these practices. Their access to sophisticated technology, vast resources, and insider information gives them a significant edge. They can exploit market inefficiencies and manipulate prices with relative ease. On the losing end are ordinary investors, often lacking the resources and knowledge to recognize or combat these manipulations. They become easy targets, left holding depreciated assets when the bubble bursts. Section 6. Eroding trust, the impact of manipulation on ordinary investors. The consequences of stock market manipulation extend far beyond financial losses. Perhaps the most insidious effect is the erosion of trust in the market itself. When investors believe that the game is rigged, they become disillusioned and hesitant to participate. This lack of trust can have a ripple effect throughout the economy. It discourages investment, hinders capital formation, and ultimately undermines the integrity of the financial system that underpins our economy. Restoring trust requires transparency, accountability, and a level playing field where all participants have a fair shot. Section 7. From GameStop to the flash crash, real-world tales of market manipulation. Market manipulation has real-world consequences, affecting everyday investors and financial stability. It can lead to significant losses, erode trust, and create an uneven playing field. Some of the most well-known market events like the GameStop short squeeze and the flash crash highlight these vulnerabilities. In 2021, retail investors on Reddit drove up GameStop's stock price, causing massive losses for hedge funds and gains for retail investors. This event showcased the power of collective action and the influence of social media on market dynamics. The flash crash of 2010 saw the Dow Jones plunge nearly 1,000 points in minutes, erasing billions before recovering. Experts believe spoofing and high-frequency trading played a significant role, creating false signals about supply and demand. Market manipulation remains a clear and present danger, impacting investors and the market. Vigilance and proactive measures are crucial to ensure a fair market. Section 8. Protecting yourself. Navigating the minefield of stock market manipulation. While the world of stock market manipulation can seem daunting, there are steps you can take to protect yourself. It's crucial to understand that manipulation can come in many forms, from pump-and-dump schemes to insider trading. Recognizing these tactics is the first step in safeguarding your investments. Educate yourself. Knowledge is your best defense. The more you know about the stock market, the better equipped you'll be to spot red flags. Consider reading books, taking online courses, or even attending seminars on stock market strategies and financial literacy. Learn about different types of manipulation, understand how they work, and be wary of suspicious market activity. For instance, sudden spikes in stock prices without any news or fundamental changes can be a sign of manipulation. Always question the underlying reasons for such movements. Avoid emotional trading. Don't let fear or greed dictate your investment decisions. Emotional trading can lead to impulsive decisions that manipulators exploit. Practicing mindfulness and staying calm can help you make more rational choices. Manipulators prey on emotional investors, so stay disciplined and stick to your investment strategy. Having a well-thought-out plan and adhering to it can shield you from making hasty decisions based on market noise. Diversify your portfolio. Don't put all your eggs in one basket. Diversification is a key strategy to mitigate risk. By spreading your investments across various asset classes, you reduce the impact of any single manipulated stock on your overall portfolio. Diversifying across different asset classes can help mitigate losses if one sector is manipulated. This approach ensures that your portfolio remains resilient even if a particular market segment is targeted by manipulators. Use stop-loss orders. These orders automatically sell your stock if it falls below a certain price, limiting potential losses in a manipulated market. Stop-loss orders act as a safety net, providing a layer of protection against sudden and severe market downturns. By taking these precautions and staying informed, you can navigate the stock market with greater confidence and reduce your risk of becoming a victim of manipulation. Staying updated with the latest market trends, using reliable tools, and continuously educating yourself are essential practices for any savvy investor. Section 9. Knowledge is power. Take control of your financial destiny. The stock market can be a powerful engine for wealth creation, but it's also a complex system where manipulation and unfair practices can thrive. By understanding the tactics used by manipulators, recognizing the signs of manipulation, and taking steps to protect yourself, you can level the playing field and make informed investment decisions. Don't be a passive bystander. Stay informed, question everything, and take control of your financial future. Remember, the stock market can be a force for good, but it's up to each of us to ensure that it operates fairly and transparently.